We begin now with a story that everyone is talking about today. Stocks all over the world extending the declines of last week. Volatility, as measured by the Cboe's VIX index, has hit its highest level in 2 years. Questions abounding at the cocktail party, but it's for even the most seasoned strategists very difficult to pin down what's happening.
I don't think the S&P 500 really goes down by 10% or more ever unless people are afraid of an earnings recession.
Bad news has been good news over the past few years, as we've seen, because bad news means that central banks will maintain ultra-easy monetary policy.
You know, we've got to remember, we're only down S&P 500 5%. We were down 7 in January, 4 in April, 4 in August. You know, this is the fourth one.
This is what the normal market is like. The true normal market has volatility that makes people get scared, and there's that cliche about the wall of worry is a cliche for a good reason. It's true. People keep valuations reasonable if they're worried, and that's where we are right now. That's why I think the bull market is not over.
When you're in it, it feels like the world's going to end, but we'll come out at some point because we're not going to have a recession.
This could be, you know, the third or fourth, fifth inning, or halfway through, and maybe it's the longest expansion ever, maybe as long as 2020.
I think the market's done for the year. I think it's going to remain choppy. September 18th was the high. Maybe that was the high for the year, and then I think we're going to have to wait for a little while. And then next year I think we climb higher.
Now, a big factor in all this, the Fed. As U.S. growth picks up, the world's most powerful central bank is getting ready to exit its unprecedented stimulus. And that's happening just as Europe, Japan, and other countries are boosting their support for slowing economies and sliding markets. So is the Fed actually hitting the brakes at the wrong time? Here's the Fed Vice Chairman, Stanley Fischer. This was at the IMF's annual meetings in Washington over the weekend.
The stronger U.S. economy should directly benefit our foreign trading partners by raising the demand for their exports, and perhaps also indirectly by boosting confidence globally. And if foreign growth is weaker than anticipated, the consequences for the U.S. economy could lead the Fed to remove accommodation more slowly than otherwise,